Energy is a significant part of not just our personal lives, but it involves everything in the economy. Everything requires energy, and everything is intricately tied to oil directly and or indirectly. So it's very important to know where the price is going, where the economy is headed, and how oil prices will affect everything else, including inflation. Josh Young is an expert on all things to do with energy. He has managed a resource company himself, so we'll talk about that. He is a CIO of Bison Interests, and he was ranked the #1 hedge fund in the world last year in 2021 by Barron's with a performance of 390% over the course of the year. Welcome to the show, Josh. It's an honor to have you and discuss your views.
Great. Yeah. Thank you for having me.
So as I've alluded to in my intro, oil is a very important asset in that it directly and or indirectly affects everything we do and all the prices we see in stores. But exactly how much of an impact has oil played on the very high inflation we saw this year?
Yeah, I think that's a great question. And the reality is not at all, because if you look year over year, oil prices are roughly flat, while inflation is, like you were saying, close to 10%. So, oil really, it sounds counterintuitive, but if you have oil today at, let's say, $80 a barrel and oil at the start of the year at roughly $75 to $80 a barrel, you can't really attribute much, if any, of the inflation that we're experiencing yet to oil.
Okay, but one could argue that, with oil above $100 for a brief period of time, that really spooked up inflation expectations, and stores had to raise prices accordingly to those expectations.
Yeah, I mean, you can argue a lot of things, but the reality is that those prices aren't coming down now that oil prices are lower. And there were a number of different factors that drove that inflation, primarily fiscal and monetary stimulus. And so even though interest rates are rising, there's still this sort of hangover effect from those stimuli. And those are by far the easiest to attribute to the current inflation that we're experiencing.
All right, let's talk about your macro outlook, and we'll discuss oil prices. And then I want to get into how oil companies should be run, because you do have experience being at the helm of a resource company yourself not too long ago. Now, Josh, oil has briefly touched above $100 a barrel right now. It's currently below that. It's been sliding for the better half of the last 6 months. What is going on? Recession fears are obviously in the air, but a lot of economists I've talked to have said that we are not officially in a recession yet. So why is oil slipping?
Yeah, I mean, this is a great question. And I probably get asked this several times a day by friends and other fund managers and so on. So I think I have a decent answer, but the real answer is that no one really knows. And so what you can present is a set of factors, but those factors sort of come together as a sort of matrix, and you try to figure it out as best you can. So the biggest factor in oil prices being lower now than they were 6 months ago is that Russian oil production right now is around where it was a year ago. And so even though there have been sanctions, and even though there was a substantial expectation that Russian oil exports, including by me, would be down a lot at this point after the sanctions that have been imposed, their exports, at least for the month of November, were roughly in line with the month of February prior to their invasion of Ukraine. So that's the biggest single factor. And then the second biggest factor is that China has been undergoing partial lockdowns because of their COVID-0 policy. And that's reduced oil demand for most of this year by about 2 million barrels a day. So you have 1 million barrels a day more of Russian production than consensus, and you have about 2 million barrels a day less of Chinese demand than consensus. And that, I think, explains sort of the biggest part of the move. But again, I think it's important to approach this with a lot of humility, because it's a very big commodity and there are a lot of different factors. And sometimes you don't even know for several years what was really driving the oil price movement.
All right, interesting. Can you comment on the impact of the ongoing Russian oil embargo that's been happening ever since the invasion of Ukraine, and how much of that has impacted the higher oil price we saw earlier in the year?
Yeah, so I think the higher prices were mostly driven by an expectation that Russian oil would come off the market. And there have been a couple of head fakes where there have been months And even I think there were like 2 or 3 months in a row where it looked like early on in the war that Russian oil exports were falling and they were not going to recover. And it does look like with poorly enforced sanctions and with things like, they joked about it, calling it the Latvian blend, where Russian oil was exported to countries that don't produce oil, blended with other oil, and then supposedly exported from countries like Latvia, which again produce no oil themselves, through sort of very basic, easy to track sorts of obfuscation. Russian oil is being exported. It's being purchased by some of the same countries that have said vehemently that they're not going to purchase it and that they're going to put sanctions on. And so I think it's just not been what people expected. That being said, the sanctions on Russia in terms of the transfer of technology and the availability of experts to help them with their field development, that actually has had an impact on their operations. And so it just takes a little bit of time for that operational impact to translate to oil production losses. So we're not there yet. The market thought we were there. I thought we were there, and it's just taking longer than we expected.
So the supply side was impacted, but not significantly. Let's talk more about supply now. OPEC came out with news 2 weeks ago. I'll just read the title of this Reuters article that came out on November 14th. OPEC cuts oil demand growth forecast again as economic challenges mount. OPEC on Monday cut its forecast for 2022 global oil demand growth for a fifth time since April and further trimmed next year's figure, citing mounting economic challenges, including high inflation and rising interest rates. So here they're talking about a slower demand, which we'll drill a little bit deeper on in just a minute, but they're also thinking of cutting down its supply. Now, how significant, Josh, is an announcement by OPEC to trim its supply? You'll recall that OPEC, where individual OPEC countries are no longer the number one producer of oil in the world. That now is the U.S. due to fracking. So how significant is OPEC still?
Yeah, I mean, OPEC Plus represents, I think it's a little over 40 million barrels a day of production. And so as a block, they are the most meaningful, potentially significantly the most meaningful block of oil producers in the world. They produce the plurality of oil, if not the majority. Yes. And so they're part of what's had me so bullish on oil over the last couple of years is evidence of limited spare capacity within OPEC and OPEC Plus. And so one of the things that's happened is that OPEC, in order to adequately supply the market earlier this year, especially when Russian production looked like it was starting to come offline, OPEC stretched and was producing and at the very least exporting, if not producing, more oil than it seems like they would be able to sustainably produce and export. So it wasn't a big surprise when, from my perspective, when they cut their production quotas last month. Yep. And it looks like they might need to actually cut a little more. It's interesting when you look at Saudi Arabia in particular, anytime they've produced from their figures more than 10 million barrels a day, their oil inventories fall. And so, you can look at that a few different ways. Either there's some sort of magic trick, or the production isn't actual production beyond that 10 million barrels a day. It's oil that's coming out of their inventory and being exported. So yeah. I think OPEC is trying to support the oil market. And I think they were trying to promote stability by increasing their exports the most they could earlier this year. And it looks like they're just pulling back to a more rational production level. So again, I think there's a lot of news articles about this because you can't say what I just said in a headline. It's complicated, it's long, it's a little contentious, but the reality is that there are production capacity limitations. We exceeded them, like it's possible to exceed them for a short amount of time. And we're in the process of that coming back to sort of reasonable levels. And so I would expect, I don't know if it happens this month, but I would expect one more cut where you get those production levels back down closer to their normal production capacity.
OPEC Plus, being the largest oil cartel in the world, does have significant influence, you're right. And so one has to ask, Josh, how are these production cuts and or increases determined? What goes into their decision-making criteria?
Yeah, I think I probably am better off not speculating too much on that. I think what I just say is that I think that they produce and sell most of what they're able to. And it's really just a question of a small amount of overproduction or underproduction relative to sustainable production capacity based on their expectation of market factors. And I think the biggest market factor was they expected a bunch of oil production from Russia to come offline, and they expected Chinese demand to be stronger than it's been. And so again, that's why I think both of those are such important factors. And what you're seeing is OPEC very politely recalibrating from a world where they expected Russian oil production to be down by 1 million barrels a day or more, and they expected Chinese demand to be higher by 2 million barrels a day or more. And so they're just recalibrating. They're taking some stress off of some of their fields that they were maybe overproducing from. They're slowing down their exports from their inventories, and they're getting back into a sort of more normal situation.
I don't want to get too far off topic because we are going to talk about your oil outlook, and the theme of our conversation is energy. But I do want to talk about the petrodollar. Now, more recently, we've seen countries like China buying Russian oil with the Chinese yuan. So we're seeing countries, large countries, kind of taking their foot off the gas on using the US dollar as a currency to purchase oil with, which is what the petrodollar is. Now, economists have speculated that should this trend continue, the US dollar would not only lose its strength, but also its relevance as a global reserve currency. Is this trend going to continue, and should this even be a concern?
Yeah, I think the reality is it doesn't matter much, because even when you're seeing yuan to ruble transactions for oil, you're still seeing the price being set based on a dollar benchmark. And so if you're the reserve currency, partly you're the reserve currency because people use your currency, and partly you're the reserve currency because people reference your currency price in order to determine transaction value. It's similar. There was news recently, a West African, I believe, country was talking about using gold to buy oil. But again, the joke about that is, okay, well, what's their exchange ratio between gold and oil? And the reality is that that's being set based on a US dollar denominated benchmark price. And so, in the end, it's really hard to move away from a reserve currency, and the dollar doesn't seem to be moving away from that status. If anything, it's strengthened over the last year and the last several years.
Okay. Finally, let's give us your outlook on crude oil. So we're currently at, looking at the charts today, $81 in WTI. Give us your outlook.
Sure. Yeah. So I like that. It's really hard to tell what's going to happen in the next few months, but I think sort of a year and further out, it's sort of reasonable to be able to expect that some of the short-term factors are really going to sort of level out. So I think over the next year, there's a good chance that oil prices are much higher. So the things that have been hurting oil for the last 6 months, like OPEC overproducing relative to their capacity, Russia being able to export sort of the full amount they were exporting pre-war, and Chinese demand being temporarily suppressed, I think all of those unwind. And even if there is a pretty bad world economic downturn that suppresses demand by, let's say, 2 million barrels a day, which would actually be a little worse than what we saw in the financial crisis in 2008, 2009. Even if we experienced that, we could still potentially see much higher prices, as in that sort of 2 million barrel a day potential demand loss scenario, the world could actually still be undersupplied by 2 to 3 million barrels a day. And when we saw oil prices go negative, that was in a situation where there was oversupply of a few million barrels a day on a sort of annual basis. Undersupply by a few million barrels a day could send oil prices radically higher to a price that, I think would make people uncomfortable to even talk about.
Do you think that long term, like I'm talking about within the next 10 to 15 years, oil prices will become much lower as the rise of electric vehicles takes over and people no longer need gasoline for their vehicles?
No, I don't think so.
Okay.
Alternative energy transition hasn't been associated with reduction in oil consumption. And I think there's often this confusion, and I think you worded this correctly, but many others, when they talk about this risk, they talk about electric vehicles being energy. They almost imply that they're energy sources. And the reality is that they need energy as an input, and they're just, they're just charging their batteries with, coal or oil or
Yes.
natural gas, or in some cases, wind and solar. And so when you think about that, and then you think about the tremendous oil intensity to mine the materials that go into the batteries, that go into their power systems, that go into ultimately making the steel, you still end up with significant hydrocarbon intensity. And you can actually see that in countries that have shifted to a high percentage of electric vehicle adoption, their per capita oil consumption is actually not down. So there are a couple of Scandinavian countries that are really high electric vehicle adoption, and they're still, it's not that they're growing their oil consumption that much per capita, it's just, it's not coming down that much. And if you looked worldwide, if everyone got to their per capita level of oil consumption, you'd see it'd be close to 200 million barrels a day of oil consumed rather than the roughly 100 that we're seeing, because people use so little oil in places like India and China and various other parts of the world. So, you know, a shift to electric vehicles, I don't think would solve the likely oil shortage that we're going to experience for the next number of years.
Interesting. Just to push back slightly on what you said earlier, alternative energy sources haven't played a crucial role in bringing down energy prices. I agree with you, but electric vehicles so far only occupy a small percentage of the overall vehicle market. Let's just hypothesize for a minute. Hypothetically speaking, if electric vehicles accounted for maybe 80% of all cars on the road, would that not make gasoline obsolete?
So it would be a challenge from a demand perspective for gasoline specifically. But again, you can look at countries that have shifted to a much higher percent of their fleet being electric, and they're still consuming as much oil per capita as they were before. So sure, maybe you're using less gasoline, maybe you're using more various oil products for plastics and various other inputs. Maybe you're burning more oil for power, which ironically some of those countries are now doing. You're likely using a lot more diesel, and there's very little evidence that electric trucks, Tesla just came out supposedly with their first semi-electric trucks. I think we're years away from that. And then the reality is, even if you do that, you're going to have a substantial battery replacement rate, and you're going to need to use a lot of oil in the countries where you're mining the materials for those batteries and the power systems in order to be able to manufacture those vehicles. So it's really hard to actually structurally destroy oil demand. And this is true actually through other energy sources over time. You almost never see that energy sources go away. They're almost never replaced by sort of the next source. They're often just, it's often supplemented. So we're still using coal, we're still using wood to some extent. I mean, shockingly, wood generation, wood fueled power is actually going up, not down in Europe and other places. And so I think there's a reasonable expectation that we'll be using more oil in 10 to 15 years, and more solar panels and more wind and hopefully more nuclear and so on. So I don't think I think the narrative is sort of very far off from history and very far off from reality.
All right. Good points. Let's talk about natural gas now. It's been a big concern for Europeans, as many people have feared that they wouldn't be able to afford energy this winter. Big problem. Now, natural gas prices have fallen from their highs. I'm looking at a chart here, Dutch futures. Now, is this trend going to continue? Is this the end of high energy prices in Europe, Josh?
Yeah, I mean, unfortunately, no. So I think the calls for the end of the energy crisis in Europe are premature. We're starting to see natural gas prices rebound as winter arrives. And so what's happened is that Europe did effectively secure enough liquefied natural gas shipments to be able to fill up their storage, but their storage levels, along with their ability to import during winter, are insufficient relative to their normal use. And even with their sort of planned reduced use, just to be able to heat homes and maintain power and so on, it's going to be a very tight winter. And unfortunately, they're likely to exit the winter, even if they don't have massive blackouts and other issues, they're likely to exit the winter with even less gas and storage than they had at the same time this year. And so it's sort of unfortunately looking like a persistent problem. And it does seem likely that European natural gas prices will rise considerably at some point this winter.
Okay, so the energy crisis may persist, but let's talk about what the energy companies themselves should be doing in light of higher inflation. You'll recall that higher inflation affected all industries this year, but particularly for a junior resource company, that should hit them the hardest, right? Their margins may have shrunk considerably. If you were in the helm or at the helm of a company and you were in the on the board of directors or in management, what should you be doing right now to try to maintain margins?
Yeah, I think it's a really tough question. I think it really depends on the situation of the company. So some companies are drilling too much because, like you said, input costs have risen a lot. Incidentally, oil prices aren't higher than they were a year ago, or aren't much higher, but their input costs in some cases are up 20 to 30%. Across their various oilfield services costs and the cost for pipe and so on. And so for some companies, they should be rationalizing their development and really focusing on their highest return prospects. Other companies should be shifting capital from development over to debt pay down, share repurchases, or dividends. And then the companies that earn really high returns, even in today's cost environment, that have great growth prospects, should be investing in that growth, because if they can profitably grow, there's a great opportunity while others are struggling with high prices and high input prices and low commodity prices. There is this opportunity for companies that can very profitably grow to stand out by growing.
Okay. All right, Josh. And with that said, give us one company that you like that you think may adhere to the philosophies that you just talked about.
Yes, sure. So one company that I own stock in is a company in Canada called Journey Energy. And so they're doing sort of a combination of acquisitions that are highly accretive, along with debt pay down in between periods of acquisition. So they're positioned really nicely in terms of being able to buy assets that others either aren't able to buy or that don't fit in their other strategies. They're able to integrate those assets very effectively. And because of their ownership of some infrastructure, they're actually a strategic buyer of some of the assets that they've been buying. And then they're well situated at some point to shift from acquisitions, when there aren't highly accretive acquisitions for them to do anymore, to debt pay down, to eventually aggressive share buybacks and dividend payments.
Okay. And finally, I'd like to talk a little bit about your experiences. You were an early investor in a lot of different things. You started investing at a very early age, and you became, I believe, CEO of a resource company when you were in your early 30s. Tell us about that process of transitioning from an investor to working in industry and now back on the investment side.
Sure. Yeah. So I started investing as a teenager. I used to read the newspaper cover to cover, and there was this Motley Fool column which I loved. And now they have a big website and all these services, but at the time it was a newspaper column, and I really liked how they thought about stuff. And so I got a discount broker account online, and I started to buy tech stocks after the tech crash, and I bought other sorts of value stocks at different times. And ultimately, I ended up, I studied economics, I did management consulting, worked at a private equity fund, and ended up getting a job with a multi-billion-dollar family office where they paid me to do my passion, which was to invest in publicly traded companies. And so in my early 30s, so we launched Bison in 2015. And in 2016, late 2016, we realized one of the companies we were invested in, there was some board dissension. They were making some strategic decisions that didn't make a lot of sense. And so I went up to Canada and I negotiated with the board and visited the assets. And they I didn't become CEO, I became chairman, and ended up replacing the board, replacing the management team, selling $80 million of assets. And then in the end, we got a hostile bid after sort of cleaning it up and focusing the asset base. And the hostile bid was for, I think it was over a 75% premium from where we were trading before. And we delivered a positive return from when I became chairman to when we sold of about 20% versus competitors that were in that same area, their stocks were down an average of 50% in that time frame. So 20% doesn't sound like much, but avoiding a 50% loss and delivering a 20% profit, it was pretty good. I feel very proud of that. And hopefully, if I ever do go active with another publicly traded oil and gas company, I'll be able to deliver similar sorts of outperformance.
Okay. Would you have done anything differently today if you were still chairman of that company? Because that was a number of years ago. If you were to repeat that same experience in today's environment, what would you do differently?
That's a great question. I think I made a lot of mistakes, and the reality is that things that look good from the outside often have a lot of challenges internally. And so I think the goal isn't to be perfect. It's just to make more good decisions than bad, and to do everything you can to avoid messing up too badly. And so I think for that company, it would be very different in today's environment. The company that owns those assets is drilling best-in-class wells, which was our view. Our view was that these lands were really promising. So if it were today, we'd probably be drilling more wells rather than selling, and we probably would fight a hostile bid a lot harder, and maybe end up with a higher price that we would have to sell for. Ultimately, public companies are owned for the benefit of and managed for the benefit of their shareholders. So maybe we would still have to sell, but for a higher price. But my preference would be with those same assets to go and develop them, because they're phenomenal. We were right on the asset quality, and it just took a few more years for oil prices and natural gas prices to come around to the point where those wells are being drilled highly economically, highly productively, and the thesis is being validated by another company.
If you could go back in time and talk to your teenage self about what to do differently from an investment standpoint, what would you say to him?
So I saw some tweets about this recently. The joke is, if you could say 3 words to yourself 20 years ago, what would it be? And it's
3 words.
Bitcoin, Amazon, and Apple.
Okay.
So, I do oil and gas investments, but the reality is that oil and gas investments are cyclical. And so I think right now is a great time to own oil and gas stocks. But 20 years ago, 10 years ago wasn't. And so I think it's important to understand the environment that you're in. And right now, we're beneficiaries of almost a decade of underinvestment. And so we have many years of promising returns, I think, in oil and gas stocks. But that doesn't mean that it was great to own them 10 years ago. And it doesn't mean that it will necessarily be great to own them 10 years from now.
Well, maybe just talk about the thought process and the selection process. You said Bitcoin, Amazon, what was the third one? Apple. I'm assuming you are implying that you didn't buy them 20 years ago. So, tell us about that process and why you may have overlooked those things as a teenager. Of course, you're not alone. A lot of people have, right?
Yeah, no, I think there's nothing magical about those. Those are just sort of the highest return stocks over if you could consecutively do it, you buy, Bitcoin when it first comes out for 10 cents. And, even after it crashed, it's at $16,000 or something. So just on a percentage basis, there's no magic to that. I think you can't predict the future. And so since I can't predict the future, I don't know which next thing is going to be Bitcoin. But I think I can know which thing is going to go from 2 times EBITDA to 6 times EBITDA while growing value on the way and growing cash flow on the way. So I think that the reason that was a joke was I don't think it was possible to know for those things, but I do think it is possible to know in terms of just doing the tough work, underwriting companies carefully, buying at low valuations, and then importantly, selling when valuations go to a fair value or overvalued.
This was a hedge fund interview question that I got. I didn't get the job, which is why I'm now talking to hedge fund managers. But a while ago, when I was working in industry, somebody asked me at a hedge fund interview, I'll give you 3 statements of any company without the notes in the MD&A. So balance sheet, cash flow, income statement. What are the top 3 financial metrics or ratios you would look at to determine whether or not you should look any further? So I'll ask you the same thing.
That's a good question. So I think I'm most interested in margins and in cash flow, and then the price to book value. I think if I could only do 3 things, I think those would be sort of the 3 metrics that I'd look for to understand if it was something I should spend more time on. Okay,
cool. Is leverage a concern for you?
Oh, for sure. But, I think leverage doesn't necessarily have to be your enemy. I think appropriately levered businesses can outperform underlevered and overlevered businesses.
Right.
And so it depends on sort of where you are in the cycle. It depends on what the cash flow profile and cash flow stability of assets are. And then it depends on what the use of that leverage is.
What about top line growth? If a company has been growing consistently double digits in revenue, is that a positive or a negative?
So consistent growth reminds me of the 1001 Days in the Life of the Thanksgiving Turkey that Taleb came out with. So it's great, and then can fall off a cliff.
Okay,
sometimes.
Exactly. That's like...
So yeah, there's no promises, and again, there's no perfect answer, I think, and there's no perfect asset class, and there's no perfect investor. There's nothing. Everything has complexity, and I think understanding complexity, embracing volatility, like I think there are advantages to accepting what you don't know and accepting what might be inherently unknowable. Because when you start with not knowing, you open up room to learn something and to be able to, I think, take careful, risk-adjusted bets that can yield positive results over time.
All right, Josh, I really appreciate your thoughts. Welcome to Kitco, and I hope to speak to you again soon. Thank you for your time today.
Thank you very much for having me on.
And thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and stay tuned for more.